Ben ritrovati, siamo sul floor del New York Stock Exchange alla fine di una settimana più breve del solito. Ricordo infatti che lunedì non si contrattava per il President Day, una settimana che potrebbe concludersi in territorio positivo. Ne parliamo con il mio ospite qui sul floor del New York Stock Exchange, che è Joseph Greco, Managing Director per Meridian Equity Partners. Joe, thank you so much for being with us.
Thank you for having me.
So Joe, we are at the end of the week, another volatile week, and we are gravitating around 13,000 for Dow Jones, S&P 500 and 3070. We touch already those numbers, but we are pulling back and going back. What is going to happen?
Yeah, the market really, those are, remember, psychological levels. Those really don't indicate anything as far as what's going on fundamentally, what's going on technically, or what's going on, on a macro basis around the world. So, hitting 13,000 in the Dow is nice and whatnot, but, it's a very small index. Whereas compared to the S&P 500, there's 500 constituent members, and that's a little bit of a better gauge of the market. Right now, what we are seeing, though, is the market is trading in a very tight range between, about a % to a 1.5% range for the last, few weeks, which indicates we rallied very hard right out of the gates this year, and now we're kind of hitting our head, and we're not able to get, through that upper level just yet.
Yeah, you were saying, of course, that there are psychological level, but a lot of people are saying that if we really manage to stay above 13,000 for a while, we may see some investors coming back to the market. What do you think?
Well, again, remember, we rushed into this rally, January 3rd when we came back to, to start the new year. The market took off and we never looked back. So now we need to get higher. And once we establish a new level, that hopefully can build in as a base, and then the market will continue to lift. Unfortunately, there seems to be a disconnect between the amount of cash that's on the side or wish they got in, and now they're waiting for an opportunity to get in, and people who are actively trading around in the market. So I think if we can get those onto the same page and you get those people to capitulate and get involved in the market, then we'll really see the market move. And 13,000 in the Dow wouldn't be a problem at all.
Now, going back to another comment, there is a strategist from Credit Société Générale, apologize, that is comparing the S&P 500 this year to what happened last year. That we saw, from October with its, until now, we are seeing this rally, as you were saying, that is still continuing. Last year, the index dropped during the second part of February, then it rebounded in April, and then we had a very volatile second half of the year. What do you think? Could it be another, a similar scenario this year?
I'd like to rewind the clock even farther back into the end of 2010, when most analysts and market technicians were saying we look good for the first half of 2011, which is what did happen. Yeah. But we don't know what's going to happen to the second half, and we don't think it's going to be good because there's no reason, there's no empirical reason, there's no fundamental reason that the market is going to sustain the growth of the first half. And the wheels did fall off in the second half. We had the debt ceiling problem. We had stalemates in Congress and the Senate. We had the White House push-pull. And then, of course, now that we start this year with the market rallying, you did have a lot of cash that was built up. You did have people surging into the market because they didn't want to miss an opportunity. And now, of course, you do have a very important election, an incumbent president running who is doing the best he can to obviously make the picture look good while it's on his watch. And of course you have everyone else who wants to feel that they're good. They're putting hope into the market, and that's buoying the market as well. I don't think that we're going to have as much of a problem in the second half. I actually think through November in the election, everything, the economic data and the fundamental equities data, are all going to improve incrementally.
And of course the market might follow.
The market might?
The market might follow.
Oh, will follow. Yes. No, I thought you said fall. Sorry. I think it will. I think it will absolutely follow, and the trend will continue. It won't necessarily continue as rapidly as we saw the first 2 months, but I think we will see that incremental growth in the market.
Now, going back to this week, we still are looking at oil. Now we are over 108 at this very moment. How much is this triggered by the tensions in Iran?
Definitely, a big percentage of that. I would say somewhere, scratching my head, 15 to 25%. I wouldn't really say much more than that because in reality our exposure isn't that much, and you can offset that, or the president could offset that very quickly by simply saying we're going to increase the number of permits for drilling offshore or drilling on U.S. soil, which would completely wipe out our dependency on Iran. So that would kind of eliminate it. Now, what we are starting to see is the bigger banks, Goldman out this morning saying we think that oil will in fact push higher, not only because of demand, but because of speculation. So now, if that was a call to speculators to get going, you can see, easily 15 to 20% move up in crude pricing or Brent pricing, just based on speculation. And that to me is a little worrisome because that will translate over into what the price at the pump is, and that's coming at a very, very crucial time where we don't need any more expense borne by the consumer. So people are already talking about $5 a gallon at the pump this summer. That means an extra, $500 to $1,000 in gas expense per household. That's $500 to $1,000 people don't have in this market right now.
Now let's talk about next week. What you're going to look at is going to be very busy, a lot of economic data. We have the GDP, we had a lot of manufacturing indexes. So what is going to drive the market?
Well, we've had really strong manufacturing indicators so far, and it's all pointing towards a continued growth and expansion of the economy. Not as aggressive as maybe the end of last year into the beginning of this year. So that's good as long as we still get the incremental growth. That'll play into what GDP looks like, which hopefully is better. Remember, we took a little bit of a step back, which people weren't necessarily surprised with, but it doesn't necessarily go with the story, which the story is incremental improvement. And I'm sure that the White House and the administration wants to see incremental improvement, so things are going to look a little better, and I anticipate that'll be the case next week as well.
Thank you very much, Greco, for being with us.
Thank you.